The average savings account in America pays 0.46 interest. Inflation last year ran at 3.4. That means every dollar you're saving is losing purchasing power, quietly, every single day. And your bank knows this. They've always known this. Let's go back to 1971. That's when Nixon took the dollar off the gold standard. Before that, a dollar represented something fixed, something real. After 1971, money became a promise, a number on a screen. And the moment that happened, the rules of saving changed forever. Because now, governments could print money whenever they needed to. And when more money enters circulation, each dollar you've saved becomes worth slightly less. This isn't a conspiracy. It's monetary policy. It's documented. It's intentional. And your savings account was never updated to protect you from it. If you have a savings account right now, this affects you directly. Here's the math, and this is where the math gets uncomfortable. Say you have $10,000 in a standard savings account. At 0.46 interest, you earn $46 in a year. Sounds fine, except inflation at 3.4 means that $10,000 now has the purchasing power of roughly $9,660. You didn't just fail to grow your money. You lost $340 in real value. The bank sent you a statement showing a gain. The statement was technically accurate. It was also deeply misleading. Now here's the part that should make you pause. While your money sits in that account earning 0.46, your bank is lending it out at somewhere between 7 and 28. Car loans, personal loans, credit cards, mortgages. The average credit card interest rate in America right now is 24.37. Your bank takes your $10,000, lends it out, and earns thousands. They give you $46. They keep the rest. This is not a secret. It's called fractional reserve banking. It's the core business model. But nobody explains it to you when you open your first account at 17 years old with $100 from your birthday. And it gets more layered than that. See, banks don't just lend your money once. Under fractional reserve rules, a bank holding $10,000 in deposits can lend out approximately $90,000. They're creating money from your money, multiplying it. And every dollar of interest generated from that multiplication, it flows back to the bank. Not to you. You're the raw material in a machine you were never shown the blueprints for. The psychology here is precise. It's not accidental. It exploits something called loss aversion, which is the documented human tendency to fear losing money more than we desire gaining it. Studies show we feel losses roughly twice as intensely as equivalent gains. So when a bank says, "Keep your money safe," that word safe triggers something deep and irrational in us. We stop asking about growth. We stop asking about returns. We just want the money to not disappear. And the bank has answered that fear so perfectly that we never ask the next question. Safe compared to what? Safe in what time frame? Safe for whom? There's also something called the saver's identity. Decades of cultural messaging have made being a saver feel like a moral virtue. And once something becomes part of your identity, you stop examining it. You defend it. You teach it to your children. The financial system didn't just sell you a product. It sold you a self-concept. And that self-concept has been quietly costing you money every single year. Think about Warren Buffett. He doesn't keep his wealth in savings accounts. His company, Berkshire Hathaway, holds cash equivalents in treasury bills and short-term instruments yielding between 5 and 5.5. Not 0.46. Even the way wealthy people hold safe money is fundamentally different from what they've made available to average people through default banking products. The wealthy know this. Almost nobody else does. When rich people talk about liquid assets, they mean money earning real returns while staying accessible. When regular people talk about liquid assets, they mean a checking account and a savings account earning basically nothing. Same concept, completely different execution. And this gap, this knowledge gap, is not organic. It was cultivated. In 2023, while the Federal Reserve raised interest rates to over 5, the biggest banks in America barely moved their savings account rates. JP Morgan Chase was offering 0.01 on standard savings accounts. At the same time, they were earning billions lending money at the Fed funds rate, or above. The margin between what they paid depositors and what they earned. It was the largest in decades. The Wall Street Journal reported it. Analysts discussed it. And millions of Americans never heard about it because nobody sent them an alert the way their bank sends them alerts when they're low on funds. Now, the important question. What do you actually do with this? Because outrage without direction is just energy wasted. First, understand the distinction between saving and storing. Saving, in the true sense, means preserving purchasing power over time. Storing means putting money somewhere and watching inflation quietly reduce it. Most savings accounts are storage, not saving. The word savings on the label doesn't make it so. High-yield savings accounts at online banks like Marcus by Goldman Sachs or Ally currently offer between 4.5 and 5.1 APY. That doesn't beat high inflation years, but it gets dramatically closer than 0.46. If you're still using a traditional bank's default savings account, you're leaving hundreds or thousands of dollars per year uncollected. That's not a small thing. Over a decade, compounded, it becomes a life-changing thing. Second, understand what money actually is in this modern system. It's not a store of value by default. It's a depreciating asset unless it's put to work. This reframe changes every decision. Cash sitting still isn't neutral. It's slowly bleeding. The question isn't whether your money is safe. The question is whether your money is working. Third, know that the system isn't going to tell you this. Your bank's app isn't going to send you a notification saying, "Hey, inflation just outpaced your savings rate again this year." Their incentive runs precisely opposite to yours. The information asymmetry is baked into the business model, which means the responsibility for knowing this falls entirely on you. And that's uncomfortable, but it's true. The real scam isn't that saving is bad. Saving is necessary. Liquidity matters. Emergency funds matter. The scam is the framing. The idea that putting money in a bank account is a complete financial strategy. That being a good saver is enough. That responsibility equals passivity. That's the trap. Because while you're being responsible, staying passive, watching your balance stay technically stable, the purchasing power of that balance erodes, and the bank uses your capital to generate returns you were never invited to share. The question was never whether to save. The question was always, save toward what? And in what vehicle? For whose benefit? Once you know that the default answer serves the bank and not you, you start asking better questions. And better questions are worth more than any interest rate they'll ever offer you.